Good afternoon, everybody, and welcome to Henderson Logie's Inheritance Tax webinar today with Lucy Crowe and myself, Darren Wiley. For those of you, that may not know who we are, Lucy is head of a private client team at AHL and is also head and lead of the Landed Estates and Rural Business team. I'm Darren Wiley, and I'm senior tax consultant also in the private client team and have a focus on the inheritance tax trusts and estates sector. Just before we get into the main part of the webinar today, if anybody has any questions, we will do a full Q&A session at the end. So please put your question in the Q&A box at the top of the chat, and we will answer the questions towards the end of the webinar. So why are we doing the webinar today? Well, as most of you are probably aware, that in the October budget in last year, there was some significant proposed changes to the inheritance tax rules. Following that, consultation was carried out a lot with a number of accounting bodies, tax advisors, individuals for the government, looking at those proposed changes. And then in the last couple of weeks, the eagerly awaited response to that was published. Despite some quite intense lobbying, discussion, rumours of potential delays, changes, or even reversals of some of the proposals, the responses showed that the changes will pretty much go through as originally anticipated, although there's a few little points within that. On the back of that, we then thought it was very useful just to then have a recap of what those changes were and to look at potential planning options now and what can be looked at before the new rules come into play. So in the first part of the webinar is with myself. I will then go over the recap of the changes, including the nil rate band, agricultural business property relief changes and pensions. And then Lucy will look at the potential planning options and what can be done now ahead of the changes coming into force from April next year. So firstly, looking at the nil rate bands. Now, the nil rate band's probably quite familiar to most people. It's been around for numerous years at this point. Currently at 325,000, meaning for the first 325,000 of an estate is exempt from inheritance tax. This band is now frozen until April 2030. It's been at that level since about 2009 and will continue to be that, as I say, until April 2030. In addition to that, maybe not so well known as the residential nil rate band. This is another relief up to 175,000. This is for people who leave their main residence to their direct descendants, such as their children, potentially former residents and gifting of the cash as well. There's a few caveats around there. But the one point to note is for estates that are valued at over 2 million, that relief gets tapered down ultimately to nil. Both of these, I should say, sorry, that band has also been frozen until April 2032. It's April 2030 as well. These excess reliefs can be transferred to spouse or civil partners. So there can be a combined value of up to £1 million that can be exempt per couple for inheritance tax purposes, which maybe you're familiar with that figure. But what does that mean? Well, with the thresholds being as they are and being frozen for a further length of time, what we're seeing in our clients and just in the wider populace is that more and more people are being caught by the inheritance tax rules and potentially subject to inheritance tax liability in the future. Moving forward to agriculture and business property relief, one of the big focus points of the budget last year. Currently, as it stands, for people who have qualifying agricultural or business property, there is 100% relief against inheritance tax. So when it's passed down the generations or left in wills, there's no IHT on those assets. However, from the 6th of April 2026, that will change. This will now only become a £1 million allowance at 100% relief. It should be noted as well that that allowance is as a combined, so for estates that have got APR property and BPR business property, that £1 million allowance will be combined between the two. There will not be a £1 million allowance for agricultural property and a further £1 million allowance for business property. So what does that mean? And it means it will be prorated between the two types of assets. So if, for example, if an estate has £3 million worth of both APR and BPR assets combined, say £2 million of agricultural property if it's a farm, £1 million of business property. On top of that, then that 1 million allowance will be allocated 2/3 to the APR and then 1/3 to the BPR. There's no plans for there to be ability to decide what allowance that £1 million allowance gets put to. The remaining qualifying assets will then be subject to 50% relief and then taxed at 40% to give an effective tax rate of 20%. There will be a simple example showing what that means in a moment. One thing that was subject of a lot of debate is if there was going to be a transfer of that allowance between spouses, which has been confirmed in the response that no, there's not. So unlike the nil rate band and the resident nil rate band, which can be transferred, this allowance will not. So that's going to mean a significant planning might need to be done, which Lucy will speak on later in the webinar. That allowance, though, for the £1 million will be reset every 7 years. So when you've maybe heard of the term of gifting assets and after 7 years you'll be out of your estate for inheritance tax, that's where that kind of comes into, and the £1 million allowance will be reset in that same way. One thing that was mentioned in the government response, though, that I don't think was previously mentioned, was that in theory, this allowance will be index linked to the consumer price index and potentially increased in future years. However, it was also confirmed within that it will be frozen like the nil rate and resident nil rate bands until at least April 2030. As a side note, for those individuals that have investments in the alternative investment market or AIM, normally they would have got business property relief subject to certain rules at 100%. However, that relief will now only be 50%. And there'll be no £1 million allowance available in those assets. So effectively a tax rate of 20% as of the 6th of April 2026. And as I said, there's a small simple example that we've got here. So this individual has an estate with various assets in it, but also has a £15 million business that qualifies for for business property relief. As it stands at the moment, 100% relief applies, no inheritance tax due. But from April 2026, then now only the first £1 million of that business will be eligible for 100% relief. The remaining 14 million will get 50% relief and taxed at 40%. As I said earlier, effectively a tax rate of 20%. That means an IHT liability will then be due as of April of potentially 2.8 million on that business. Moving forward on to trusts and how that £1 million allowance applies to them. Trusts will be eligible for the £1 million allowance as well. And for trusts in existence already, they will get that £1 million allowance. Going forward from the 6th of April 2026, when new trusts are set up, potentially they will get the £1 million allowance as well. However, consideration needs to be made for those when multiple trusts are set up by one settlor. That £1 million allowance will be split against the trusts and it will be allocated in chronological order. So for example, if I decide to set up a trust myself in, say, May 2026 and put £750,000 of business property assets into it, that will be covered by the £1 million allowance. But then if I go in a couple of months later and decide to set up another trust with another 750,000 of business property assets in it, then that £1 million allowance will be first used up, 750,000 on the first trust, and only the remainder 250,000 will be used in the second trust. So then that could lead to potentially higher tax on the second trust rather than the first trust. In addition to that, that's also going to require both trustees and tax advisors, your tax accountants, to have detailed records of knowing when those allowances have been used, just to ensure all the rules are being followed correctly. One thing that was confirmed as part of the recent response update was the fact that the related property rules will not be applied to trusts. So for those that may not know, if you take, for example, husband and wife, spouses, civil partners, if they both own shares in their company, maybe it's an owner-managed business, and they own 30% of the shares each, that 60% share combined would be almost seen as a controlling stake, would be worth more than two individual 30% shareholdings. Those rules were being considered for trusts as well, where there was multiple trusts set up by settlers. However, the government's confirmed that that will not be happening, and it will just be based on the value of the trusts. So maybe a small crumb of comfort there. So then how does the allowance then work with the 10-year anniversary charges and exit charges for trusts? Well, as it stands, when it comes to the next 10-year anniversary following the 6th of April 2026, the 10-year charge will apply. So if, for example, I have a trust in situ just now that then is due to have a 10-year charge in September 2025, then that would be carried on, but potentially full business property relief would be applicable. But then in the next 10-year charge and then subsequent 10-year charges after, so the first one being again in September 2035, the £1 million allowance would be considered at that point to reduce the value of what's in the trust at that time. For periods before now, it will be prorated. So if you have a trust 10-year charge that's due in, say, 2030, the period before the rules come into play, that will be still given effectively as the full business property relief. And then the period after 6th of April 2026 will then be subject to the charge. So there'll be elements on there. The new rules will also apply to any exit charges. So if a trustee decides to give business property relief as a distribution to one of the beneficiaries, the £1 million allowance will be considered as part of that. That can then potentially reduce that distribution, potentially even down to no exit charge. But then when the following 10-year charge is considered, what's been used up for the allowance for the previous exit charges will be considered as part of that 10-year charge to reduce the amount of the allowance available. Finally, for trusts, the transitional rules will apply unchanged for trusts set up before the 30th of October 2024. So that means potentially assets can be distributed before the 6th of April 2026, and the full BPR can be given or APR can be given at 100% relief. For those maybe looking to settle assets into trust, then the full relief can still be given before that point. However, care needs to be made that if something was then to happen to the settlor, and they say they passed away within the 7 years following the gift to trust, then that might still fall within the £1 million allowance and be chargeable to the trustees. So just a few points to consider there. And then finally, looking at pensions, as many might be aware, the pensions will also form part of inheritance tax from the 6th of April 2027. Now, we're not going to go too much in depth into pensions on this webinar. We are planning to do a follow-up webinar probably early in the new year, maybe February time, that will go into a bit more depth into pensions. So please look out for that when that gets announced. But as a summary, pensions effectively will be subject to inheritance tax from the 6th of April 2027, any unused funds. Now, for those of you that might have a self-invested personal pension plan or a SIP, sometimes these and maybe other pension schemes hold underlying assets within them that might on their own be eligible for APR or BPR. And it's been confirmed that they will not get a £1 million allowance. So the government's viewpoint is that the pension is considered as the asset itself rather than the underlying assets that it's held. And then these pots will be taxable to IHT at 40%. So again, quite significant. Pensions were a very good way of previous IHT planning, so that might need some consideration going forward from there. Another point with pensions is that if a person is over 75 when they pass away, once the beneficiaries start to draw down those pension funds, they will also be subject to income tax. Now, depending on the level of income that the beneficiary has themselves, that could lead to an effective tax rate of up to 76%, so particularly quite punitive. A couple of points, though, from the government response for a bit of clarification and a sort of confirmation was that death and service benefits will remain excluded from inheritance tax. There was some concern that death and service benefits, and for those that maybe don't know, for a lot of people in their employment, if they were to pass away while they're employed, part of their benefits of employment is maybe a payment, maybe 3 to 4 times your annual salary upon death. That might have been included as part of the estate, but it's been confirmed that that will not happen and will still be exempt from inheritance tax. And then the final bit, sort of point on pensions, is that pension representatives or executives of the estate will be the ones ultimately liable for reporting and paying of the IHT from the unused pension funds. In the original proposals, it was mentioned that pension scheme administrators would be liable for that reporting. And while there's a few caveats within that to consider, as I say, we'll be looking at that probably in a further webinar, just to make sure it ultimately will still be the representatives that are liable for that. The government kind of understood that there was a lot of additional burden and a lot of additional admin by getting 2 different people to effectively be responsible for that. So they're just moving it to the representatives. So as I say, please look out for our webinar on pensions early February time. And that's just a recap of what the changes are. And I will pass you over to Lucy, who will talk about the planning options. Thank you.
Thank you very much, Darren. Important just to understand what those changes are. And before I start talking about what planning you can look at, just a quick reminder, we do have the Q&A box down there, and we will run through any questions that you have at the end of this webinar. So pop any questions in, and we will deal with those at the end. So planning. Obviously, these rules are big changes, and as you saw from Darren's example with the £15 million business, that's a big difference going from no IHT on that asset to 2.8 million. Where we like to start is a review of your assets. What assets have you got? What we normally prepare is what's called a statement of assets, just listing down everything that you've got, and then looking at the value of it. And valuations are much more key now with these new rules, and I'll talk about that on the next slide. But getting the assets, working out what the values are. For some assets, an estimated value is probably sufficient, but important to get proper valuations for those key assets. And then we look at what reliefs are available. So, are there no rate bands available? Are there any additional ones? And then the key ones, obviously, are the agricultural property relief and business property relief. It's important to confirm that those are still available. And one of the things that we see frequently with clients is good trading businesses that should qualify in full for business property relief, but perhaps they've been doing very well over the years and there's just a bit too much cash sitting on the balance sheet, and that can sometimes affect whether BPR is available in full. So it's important to establish that first, and where it is APR, this agricultural property relief, or BPR, the business property relief that you've been relying on, they're now going to be restricted, as Darren showed. Are there other reliefs available? Particularly with our landed estates clients in the last few months since these proposed rules came out, we've been looking at heritage asset claims, and we've got the first few already into HMRC. And that's a very valuable alternative for those that qualify. So it's not all doom and gloom. It might just be a pivot to different reliefs, but it is important to look at those and work out what ones are available. And the other thing that's important to think about before you start your planning is where you ultimately want your assets to end up. Are you passing assets down to the children? Do you want certain assets to go to certain children? And also consider the family circumstances. Before you pass assets away, how much do you need for the rest of your lifetime? Now, that might be your capital requirements, but also if you give away capital because you don't think you'll need the capital, if they were income producing assets, that could also restrict your income. So thinking carefully about that, but also about who you're going to pass things on to. If it's family members who are perhaps, children, grandchildren who are quite young, do you want them to have unrestricted access to assets at a young age? And young age is a very subjective one and depends on every different family. So those are the first things that we look at with our clients. Once we've got that, we then look in more detail at the valuations. So for the valuations, this is something that for years with fully qualifying business property relief, agricultural property relief assets, an estimated value was often sufficient because there was going to be no inheritance tax at stake. And the other thing that's important to note with all inheritance tax planning is capital gains tax normally applies as well. And we'll look at that a bit more on the next couple of slides. But now that the APR and BPR are restricted down to $1 million and it is potentially taxable on the amount above that, you will need accurate valuations. You can still use estimated valuations, but given this tax at stake, much more likely HMRC will come back and challenge if they feel the values are too low. If you've had a proper professional valuation done, then that's something that you can go back to HMRC with. Because we haven't needed accurate valuations necessarily, given that the tax implications, there's maybe assets have passed down generations and have had no formal valuation done. So get expert valuers, whether that's property valuations, business valuations. So we have a lot of property valuers, whether that's in the residential market, the landed estates, forestry, that we've worked closely with over the years, and we're always happy to pass on recommendations. If you've got an owner-managed business, your own business, we've got an excellent corporate finance team who we work a lot with to do valuations for the various businesses. And pensions will also need to be valued now that they're falling into the inheritance tax net. Usually the pension provider can give a pretty accurate value, but it is important to get all of those correct. So where do we then start with the planning? The planning we see most often is where clients are looking to pass down the value to the next generations. Usually that's straight down to their children, but sometimes bypassing a generation, going down to grandchildren, nieces, nephews. And you've got three main options: passing assets directly on to family members. And obviously this can be to friends as well, but the one we see most often is passing down directly to family members, gifting to trusts, or creating what we call family investment company or FICs. And there's advantages and disadvantages of all of these. Looking first at direct gifts. If you are gifting cash to individuals, there's no capital gains tax to worry about. So although I said you need to look at both capital gains tax and inheritance tax on any planning, where you're gifting cash direct to an individual, you don't need to worry about the capital gains tax. This is usually what's called a potentially exempt transfer. It's a thing most people are aware of, and that's that 7-year rule where if you pass it on and live for 7 years from the date you've gifted it, there's no inheritance tax due. So you've no IHT and you've no CGT. However, one of the biggest mistakes we see in inheritance tax planning is where people gift assets and they're aware of the 7-year rule for inheritance tax, but they're not aware that because they've passed an asset on, that's actually a chargeable disposal for capital gains tax, and there can be capital gains tax due. So that's something to watch out for. And the other big disadvantage with gifting down directly to family members is the loss of the future income and the capital for the person gifting it, and also where you might feel that the individual that you're passing it on to is not quite ready for that level of responsibility, or that you're just not quite ready to let that control of the asset go, especially if it's a business. If it's a business that you've spent years building up, you might not want to pass on too much of the control. So this is where we often start using trusts or family investment companies. So to look at trusts first, gifting to trusts, again, you've got to consider both inheritance tax and capital gains tax, but there's some very generous reliefs for capital gains tax when you're gifting into a trust. And trust can be a really useful way of retaining control of an asset, especially if you don't want it to go to particularly young children or vulnerable children, and them having unlimited access. If you put it within a trust, you can retain control and how much access they have both to the income and to the capital. So a really useful vehicle, and we'll look in a minute at an example of how useful they can be around the APR and BPR planning. But one of the big disadvantages with trusts is when you put the assets in to get that inheritance tax relief, you are losing complete control over, sorry, not control, you retain control, but you lose access to the capital and to the income. If it's the settlor, the person who set up the trust, if you can benefit in any way, you lose all of the inheritance tax reliefs. So you're passing on the assets, and if you still need money from them, that's where we would usually look at a family investment company instead, because you can pass the wealth around the generations, lessen the capital value that still sits with the lead generation, but they can still have access to income. So a really useful vehicle and something we're seeing more and more at the moment. So if we now look at how we're using these vehicles and maximising the reliefs, especially around the agricultural and business property relief. And one of the things I will say is we're just focusing very much here on the agricultural and business property relief, but we do look at trusts and family investment companies for so many different reasons across inheritance tax planning, and we will be doing a specific webinar on them next month. So watch out for that next month. And we will go into detail on trusts and family investment companies. We'll compare the two. We'll look at when you might use each one. And very often what we find with our clients is actually a combination of both for the bigger estates. So looking now at the release for APR and BPR. As Darren had said in his example, the £15 million estate owned by the business owner, a £2.8 million IHT liability after the 6th of April. Now, let's imagine that this business owner is married, they've got 2 kids. If they were to pass 2 million of their shares in this business over to a spouse, and then both spouses then put 1 million into trust, you've now got 4 £1 million allowances rather than 1. And if they were also to gift down, say, £1 million to each of the children, that's £5 million less in the business owner's ownership, and that would reduce his taxable business asset down to 10 million from 15 million, and that would reduce the IHT down to 2 million. So you can see that that's an £800,000 IHT saving from what is relatively simple planning. I would say again, it is always important to look at each situation, but that's just to give you an example of what can be done. Now, each spouse gets the allowance, but what's important to note is that, as Darren said, you can't pass the allowance between spouses, so it's important to utilise that on the first death. So where you might have had spouses where everything was left to the surviving spouse on first death, and then passing down to the next generation on second death, if those wills stay in place with no changes, you're going to lose one of those £1 million allowances because it won't be utilised on that first death and it can't pass across. So updating wills is going to be a key part of maximising these reliefs. The last thing I would say is that you can put more than £1 million into a trust. Sorry, we're moving on the slide slightly too quickly there. One last point on this one is you can put more than £1 million into trust up to April 2026 with no IHT. Now, after April 2026, you can put £1 million into trust with that business property relief, agricultural property relief. But if you go above that, there would be an immediate lifetime charge on the excess you put into trust. If you're putting it into trust before April 2026, there isn't. Now, if you don't survive for 7 years, the charge potentially comes back into charge. But that is something that is worth considering, especially for those that you are expecting to live for 7 years after doing a gift like that. So something worth looking at. And then, yes, we'll go on and look at what if you have a business and you don't have family to pass it on to? Because from many owner-managed businesses, landed estates, farms, that's the aim. It's been to pass it down to the next generation, pass it on to the family. But sometimes there's no one in the family that wants to take on a landed estate, a farm, or the family business. What can you do in that situation? Well, we did do a webinar on this a couple of months ago with our corporate finance colleagues. So you can sell the business, obviously. You can wind the business up and extract what funds are in there. But if you wanted to look at the business continuing, if you've spent years building up that business, you might look at a management buyout or an employee ownership trust. So there are a lot of options if you have a business and no one in the family that you want to pass it on to. There's a lot of tax implications around any of these options. Maybe pop back and have a look at that webinar, take good advice. And if you have sold, wound up, you're likely then to be sitting with cash, an asset that does not qualify for agricultural or business property relief. So it is then important to think about your IHT planning and what you do next. So that's been a bit of a whirlwind through some of the planning options. We can go into a lot more detail in most of those options, but to fit everything into a webinar today, we've just really given it a high level overview, and we'll come back to family investment companies and trusts next month. But once you've done all of that, so you've decided, you've looked at all the options, you know what your assets are, you know what the value is, you know where you want things to end up, and you've had someone like ourselves lay out the options on what the type of planning is and what all the different tax implications of that would be, we would then suggest bringing in your solicitor. And we've got lots of wonderful solicitors that we work with a lot, if you don't already have one, because for a lot of these, you're perhaps restructuring the way a partnership's performing, maybe bringing in new members, or if it's a company, reorganizing the shareholders. So it's important that partnership agreements or shareholders agreements are updated to reflect that, because that's really important to protect the business and the family. And honestly, it really does prevent arguments in the future. It might be if you're passing things directly down to family members, you want pre or post nups. So important to get a solicitor in. Then we would look to actually execute the planning once all of that's in place. And at that point, it's then vital to update those wills so that that now reflects the assets that are each held. And as we said, for those of you with agricultural and business property relief, assuming that you have got at least £1 million in each name between spouses, that at least £1 million is left down to the next generation on first death, so that you are getting the maximum of those £1 million allowances. And once all of that's done, we would also suggest that clients consider any insurance. So if you've done a lot of planning, that perhaps has a 7-year runoff period before it's exempt, then you can look at insuring for that 7-year period. Or if you're going to stop the planning at a point where there would still be a significant liability. So to go back to our example, our £15 million business, we're assuming the business owners perhaps put some in the wife's name or the spouse's name and into some trusts and pass them on to the kids, but there's still a £2 million liability. They could then consider insuring that liability, which would protect the business so that you weren't having to extract large funds from the business. So I think one of the keys is there is a lot of planning that can be done. There is some that is going to be a lot more effective if you do it before April 2026, and make sure that your tax advisor, your solicitor, and your financial planner are all able to work well together. So that would be our final comment. So on to the questions. So the first question, what is meant by heritage assets? That's a very good question and something we didn't cover. So a heritage asset is one that has significant cultural value, historic value to society. So there are a lot of conditions for heritage assets to qualify. You have to be able to show that it does have that historical cultural value, and it then has to be accessible to the public for a certain number of days a year. So there are quite a few conditions around that relief, but it is a very valuable one for assets that qualify, because it is like agricultural and business property relief used to be. It's 100% relief.
Another question we have is unused nil rate band and resident nil rate band passed from deceased spouse to living spouse still allowable? Yes is the short answer. As you might be aware, this is covered earlier, that the nil rate band is 325,000 and the resident nil rate band is up to 175,000 depending on circumstances. And yes, those can both be transferred in full if unused to the living spouse from the deceased spouse. So a maximum of 650,000 for the nil rate band, 350,000 for the resident nil rate band, to give a total of £1 million exempt for that surviving spouse.
And another question there, are there any changes to the conditions to meet agricultural or business property relief? No, there haven't been any changes to the conditions for those, other than obviously the restriction in the amount of the allowance available. So any assets you have that were qualifying for agricultural or business property relief, as long as they still meet all the conditions, then they will still qualify, just obviously with that restriction to the 1 million. And we would say that particularly for business property relief assets, it is important to review those on a regular basis, just to make sure that nothing's changed, such as too much cash or investment assets held within a business.
Another question we have is, would you expect to see a rise in the use of trusts again? And I think, as Lucy spoke about earlier, trusts are still going to be very particular to individual circumstances and to suit needs based on control, use of assets, etc. But certainly with the potential allowances available for trusts and the fact that, on an exit charge or a 10-year charge, the maximum tax rate is 6% for trusts, which might still be a lot lower than the 40% on an inheritance tax charge. There might be still enough planning in there to actually justify for a lot of people actually using trusts, even with some of the ongoing costs, especially if you consider maybe people who don't want to keep assets there for a long time, or again, just to keep that control going forward if children are too young, etc. So I think that's probably very likely to see that.
I think we're already seeing that. We've seen a lot more trusts and helped set up quite a lot of trusts just since October last year. But I think the one we're seeing a bigger increase in is actually family investment companies. So we've seen a big increase in the number of people considering family investment companies. And another question we've had is agricultural property relief still going to be available for forestry? The short answer is yes. It's still available for forestry, but just like every other asset, there is that restriction. You are limited to 1 million at the full 100% relief and then 50% thereafter. So forestry is still a very, very valuable asset for inheritance tax planning and does still qualify for a number of other tax reliefs as well. So I think that's all the questions we have had just now. Oh, no, more questions coming in. So where a settler sets up multiple trusts, say 3, and later winds up trust 1, can the APR-BPR 1 million band originally allocated to trust 1 transfer on to the next trust? That is a very interesting question. The legislation as it reads just now would suggest yes, but that is something we're going to have to delve into as the legislation comes out. As with all legislation, once it comes in, there's normally sort of clarifications and case law that come in to support legislation once it's in. So I would suggest the answer to that one is yes, but I would not guarantee that one. So I think if there are no more questions, all that remains is to say thank you very much for joining us today. Please join us again in a month's time. We'll be advertising that shortly, where we'll look at the trusts and FICs in more detail. But also, if you do have any questions on anything in this webinar or anything inheritance tax related, do get in touch with us. So thank you again for joining.